let's start the class. We have 3 more classes left till the end of the course, so we did the main part of our course. And today I want you to introduce to the very big and interesting topic, and there are it's one of the topics. There is a frontier of research in corporate finance, and this is the topic that you might use not only in finance related issues, but it also has an application in general managerial issues that is based on the idea that we will discuss with you now. It's called the derivatives. Here is the plan for the class today. So firstly, we will discuss the main types of derivatives. There are more than those that we will mention, but those are the basic ones that you should know. And as the concept of it is that the derivatives are financial instrument based on other underlying assets. And this idea allows financial managers or banks or other financial institutions to create new types of derivatives. And that is why this field is constantly developing. And we will mostly focus today, so we will introduce multiple types of derivatives, and we will deeply discuss just one type, which is the main one to know, and other derivatives are mostly somehow related to this primary type of derivatives, and we will talk about options. We'll talk about the main types of options. There are 2 main criteria by which we can distinguish them that we will cover with you. Then we will talk about the option valuation. It is not that straightforward as, for example, bond valuation. Then with a bond, we have a predetermined cash flows. With a stock, there is more uncertainty, but still the idea of the stock valuation method is also based on the discounted cash flow idea. In this case, the specifics of options prevent us. It doesn't allow to build just linear discounted cash flow models in order to estimate their value, and we should be more creative there, but fortunately there are tools implemented that we can use. And the 2 main methods for option valuations are binomial pricing model and the Black-Scholes formula. They are related, so Black-Scholes is the ultimate version of the binomial pricing model, and those are the plan for this course. So first, let's discuss what derivatives are, what it means. Derivatives, it is the same word, derive, that you might see in the math course. So those are instruments which are derived from another instrument. So they are somehow, the price of derivative depends on the price of the underlying assets. Historically, they were invented in order to secure from the risks. Let's say we invest in a gold, or we have some contract, and we want to secure that regardless of how bad price can get, we still receive our money. In this case, we, for example, can sign a forward contract. It is a type of the instrument. Then we agree with another side of the treaty that in some time we will either purchase or sell some asset at the predetermined price. So the date is predetermined and the price is predetermined, and it can be very useful for example, if you are a farmer and you know that in autumn you will have some amount of wheat that you want to sell. and you do not know what will be the current market price, but you want to make sure that you will have enough to support your business, and then you can sign the forward contract. For example, now in winter or in the spring, that in September you will sell 10,000 kilograms of wheat at price of 20 rubles per kilo, let's say. And then you can be sure that you will sell it at this price. But the problem is that the price can go up. So it on the current market price in autumn can be better than the one that is in the forward contract. Then you will have some losses, as you still has to exercise the forward contract. But if price will be lower, you will be lucky that you can sell it at the higher price than the market. So the historical idea of derivatives were this: in order to protect real business from different risks associated with the changes in price of their products. But eventually, this became more widespread. There are some exchanges appeared where such types of instruments were traded, and type of contract, of forward contract, that is has some predetermined and some fixed amount, some fixed form in order to be traded. So let's say the contract to sell 100 pounds of grain at the predetermined price, and as there are multiple suppliers of grain, there are multiple buyers of grain, it might be of interest for them to be able to trade such types of contracts, and this is how the futures emerged. So the forward contract is something that is settled between two parties, and it is individual contract. The future contract is similar, but it has some fixed form for the type of asset which is uniformal, and it can be traded on the market. And finally, as we discussed before with you, that for if you imagine you have a future contract to purchase some amount of oil at some time in the future, but it happened that in the reality the price on the market is lower than the price in your future contract, and you might be not interested in order to exercise such contract. Then instead of future contract, you can purchase an option. Option is a special type of instrument which gives you the right, but not an obligation, to either buy or sell some underlying assets. And for this opportunity, you have to pay some fee for the option. And how to determine the real value of the option? This is a tricky question, because we do not know what would be the actual cash flow on the option. We might expect some cash flow on the underlying assets, but we do not know what the cash flow on the option, how valuable it will be, because it depends on another asset. And this is why there was a problem with its pricing. I told you that there are several classifications of the options. The main one presented here. There are two types of options depending on which kind of right they give you to those who purchase them. There is a call option, which gives you the right to buy an asset at a predetermined price. And there is a put options that give you the right to sell an asset. So call option gives you the right to buy, and put option gives you the right to sell. So how to remember this? Have some analogy in your head. So put, it's like, imagine you put something on the table in order to sell it. So this is the option to put. And call, like you can call by the phone or call someone personally, asking, do you want, I want to buy something from you. So in this sense, that is why it is called option to buy something is called call option. And important feature of the bond or excuse me, of the option is an exercise price, or it's also called the strike price. It is a price at which you can buy or sell underlying asset. Because the value of the option, the two primary factors that would affect this are exercise price and the current market price. And their relation determines the price of the option. There are some other factors, but their effect is smaller. The two main factors would be market price and exercise price. And as in order for one side of the agreement to have a right to do something, another side of the agreement must have an obligation to do this. So if you buy a call option, as we just discussed with you, you would have a right to buy an asset with a call option. But you should have someone from whom you buy this asset. And this can be, for example, bank that would sell you this option. So here, this side has a right, this side has an obligation, and that is why this side, so those who purchase the bond, would pay some money to another side. So they would pay the commission for the option. And commission, when people started to thinking what commission must be paid, they started to thinking on the option valuation. And this is one of the things that we will discuss with you today. So there are always two sides. Long means that you have this option. Short means that you issued those option, and this would be your obligation to sell it. So you buy, this side buys, from this side sells. The put option is the reverse situation. You have an option to sell something, so you must have someone who will buy this from you, and this would be the short seller. And here again, those who have it long, so those who purchase option, they would pay commission to another side of the option agreement. Here are some other terms that are related to the option. It's intrinsic value that we can recalculate daily, or every moment we can recalculate it when the option is traded. It is a difference between strike price and the price of the underlying asset. As the commodity or underlying asset is traded, the price changes, and therefore the intrinsic value changes as well. The time premium, it is the value of the option above the intrinsic value. So if it is traded at the value which is higher than intrinsic value, it is mostly due to the fact that there is some time till its expiration. Expiration date is the last date on which the option can be traded. And here we approach second classification of the options. These are American option and European option. These days, it doesn't mean that American option only available in the US and European option only available in Europe. This is some historical terminology, but which is universally accepted. But of course, both in the US, in Europe, in Russia, you can buy both types of these options. The American option can be exercised at any period before the maturity. European option can be exercised only at the expiration date. This is the difference. Here is the example of the pricing of the options. So we have how it's organized. We have a set of options with the different exercise prices. Depending on them, there will be different value of the option. So the higher, here we have the higher the exercise price, the lower would be the value of the option, and of the call option, the higher would be the value of the put option, because put option gives you the right to to sell something. Yeah, and if you can have a right to sell something at very high price, it is more valuable right than selling the same thing for the lower price. This is why the difference here is goes in this direction. And on the call option, we have the opposite situation. If you have a right to purchase something cheaper, it is more valuable right. Here I have we can go to the demonstration mode and I will show you now the example of the actual data on the options. Here it is. This is the website of the Moscow exchange. It is an exchange in Russia that trades options. And here we can see the strike price, the call options, the put options, and so the table is quite big, but the trading happens somewhere in the middle. So here we would have what we have here. Strike price is here. It would be the last trade. Here is the strike price. The higher would be the strike price. The lower is the value of the call option, and the high would be the value of the put option. So this is how the trading is organized. There are multiple options with the different strike prices, and for them we have from one side call options, from another side pull options. Here we have an information of the recent transaction, date of transaction, change in price, the price of the transaction, and this is where you can inspect the real trading on the options. Let's go back to the slides. Here again, the example of, as you saw it in reality, these tables are quite complex, but the main data there is the same. So those will be exercise price and the price of the option, which is currently on the market. If the exercise price is close to the current market price, then the value of the option would be close to zero. It is so far it is simplified model, because also we have to introduce the price of the option itself. But like anyway, the tendency is it holds as we have an option which exercise price of 80, and if the market price is lower than the 80, then it makes no sense to exercise this option. Again, this option, call option, gives us the right to buy asset for $80. If the market price is $100, $110, this option is in the money. This option has a value. It makes sense for us to buy it at 80, to buy it with a discount. If the current market price is 70, it makes no sense to exercise the option. An option gives us the right, not obligation. And therefore, we do not go negative here. We only lose the commission that we paid, but if the option is not in the money, then we just do not exercise it. So therefore, here we go to zero instead of having losses. And with a put option, it will be the opposite. If we have right to sell something, we have a right to sell asset at 80. If the current price is 70, this right is valuable. Here are the charts four types of positions in the options. So put option, call option, holder of the option, so those who have it long and those who have it short. It makes sense from the definition of the option. If you have a call option, once the price goes up above exercise price, you have a profit. And theoretically, it is not restricted. So if the price goes somewhere to infinity, the call option value also goes somewhere to infinity. On the other hand, the potential losses of short of the bank or whoever would sell you this option are also unlimited. So gain of one party are losses of another party, which is one of the principles of finance. If you have a right to buy something way cheaper, then someone must sell you this way cheaper, and this is bad situation for this side. But if you go in this direction, then you do not exercise the option, but you already paid the commission. So in this direction, the seller of the option is in a good position. With a put option, we mostly our gains are restricted, as the price of the assets cannot fall below zero. Our potential gain cannot rise above the value of above the exercise price. And so this 540 exercise price would be the maximum gain that we will have as a put option, with the same with the other side of this option agreement, but mirrorly reversed. If we do it strictly and considering all the factors, we have to redraw those charts in this way. The difference between those charts and this chart would be that we included the option price. As in order to have the option long, we must pay the exercise price of it. And therefore, if we have option with exercise price of 540 and we paid $46 for it, we break even with our investment in an option only when the market price goes above 566. In order to cover the exercise price and the commission that we paid for the option. If the price of the asset goes above 566, then we have a profit. If the price below this, then we have losses, and once it reaches 540, we have the same loss. So in the worst case, holding the option, our worst loss, if we buy the option, would be the value of this option, the price that we paid for it. Our losses cannot go any worse. With a put option, the principle is the same, just the direction is reversed. What we can do, so as the option is a hedging instrument, so this is the instrument that was designed to hedge the risk. Eventually it became speculative, so those who try to outperform the market also use them, but traditionally it is a hedging instrument, and therefore it is usually combined with the other types of assets. Here we have it's called the silly strategy, so some combination that makes very bad sense, so it leads to the situation that you never win from the assets you have. You can purchase the stock, so having stock long, it means having the stock. And you can have a short on the call option, so you would have obligation to sell an asset. And what would be the result? If the stock price goes down, then your stock depreciates and your value of your investment goes down. If the stock price goes up, then you have an obligation to sell it at the exercise price, and you lose all the gains that you might have from the appreciation of your stock. So this kind of strategy makes no sense. And it is here to illustrate you that you should be careful when combining your assets. So some of them make sense, others are very, very irrational. Here you have more reasonable option strategy. It's called the protective put option. So you purchase again the stock, but instead of short selling the call option, you would go long with the put option. And it means if the stock price goes down, then you can exercise your option at some predetermined price of the price of the put option, so you can sell it at the exercise price, which is at this level. And if the price of the option or price of the stock goes up, it means that you do not exercise your put option, but you benefit from the appreciation of your stock. So you see, if the stock price goes up, your results are worse than in the case that you just purchased the stocks. You see, your results would be here because you spent some money on the option. But if the stock price goes down, instead of having your results approaching zero, you would have your results protected from the downside risks. So in any case, the value of your investment won't be lower than exercise price of the option. And this is the idea. So you are protected from the falling of your assets price. Another type of strategy can be that if you do not know the direction of the movement in the price, but you are sure that the magnitude would be strong, either positive or negative, then you can have two options simultaneously, and just if this change in price will be bigger than the value of long and put options in those regions, you benefit in both of those regions. But if the change is lower than the price that you paid for options, you might have some losses. And this idea of combining the assets also is important for us when we will approach the topic of option valuation. We can replicate the cash flows that we receive with the option with another options or another assets. Like in this case, if we buy the call option, have some money in the deposit in order to exercise this call option, and we can also play short on the stock, then your combined payoff would be the same as the one you received by buying the put option. And indeed, you can see that it will work. So in this case, if you sell, if you go short on the stock, if we add this part and this part before the exercise price, we will have this chart. So we start from here like we do in this chart, and the higher market price, the lower would be result due to the change in this part of our portfolio. Once we reach the point of the exercise price, the losses on the short selling of the stocks are compensated with the gains and profit we receive by having the call option, and therefore in this side we have a straight line. And with this idea we have multiple conclusions out of this idea that we will benefit on. And the main one is the parity of the put and call options. The parity here is presented for you in the formula way, and it's also presented as sentences. Let's understand the idea, because this idea is quite straightforward, but it is very useful for all the further discussion that we have. In order to exercise the call option, we must have enough money to do this. So we must have enough money to exercise price. And as the option will be exercised somewhere in the future by its design, so it is designed to be exercised in some period, either in any moment when we talk about American option, or in an exercise period if we talk about European option. And we must have some money, and it will happen in the future. So we do not need to have full amount, but we should have the present value of this exercise price. And this would be one side of the parity. And the same cash flow would generate for us another combination. If we have a put option that gives us the right to sell an asset, we must have these assets, and therefore we must have the value which is equal to the share price. Yeah, it is here I wrote the share price, but it can be any type of asset. So the further example that we will work with is based on the stock, but it can be the same for grain, oil, gold, any commodity, or any other underlying asset. And this is the the idea is quite simple. It goes from the nature of the options, but it will help us. Here we have a chart where the boundaries of the stock of the option price are presented. So far we will talk about the call option. If the exercise price of the call option is minimum, around 0, then the maximum gain would be very close to the price of the stock. If the stock price goes somewhere high and we have a right to buy it at exercise price close to 0, then our gain equals this market price of the option. If the exercise price goes upper, the higher it goes, the less valuable would be the call option, and eventually the maximum gain that we would have would be the difference between the share price and the exercise price, from this boundary. So the types of the area at which we might have a value of the option is limited to the exercise price. Yes, excuse me. Yeah, so those are the two boundaries. So boundaries are determined by the exercise price. The lower it is, if it's very low, it's close to the market price of the asset. If it is very high or any substantial value, it will be the difference between market price and exercise price of the option. And therefore, as it depends on the market price, option value for us, the features of the market price of the assets are becoming important. And this similar chart we discussed earlier, this asset B is more risky than the asset A, as it has higher volatility, higher standard deviation of the price. And this is another principle and another thing that is important in terms of the options to understand is the more risky asset values less, other things equal, but the option on the more risky asset values more, other things equal. Because option is a hedging of the risk, and as we hedge risk on something riskier, it is more valuable. This is the principle, and also it can be proven mathematically. Here I included this is from the book. This is the effect of different changes of different factors into the value of the call option. And most of those changes can be derived from the formula. So let's say we talk about the stock price. So we are interested in the value of the call option, and stock price here, if it goes up, the value of the call option goes up as well in order to remain this equation. Exercise price, negative. Yeah, if this part goes up, exercise price, and its present value goes up, in order to keep the equation equal, the value of the call option must go down. Interest rate also positive, because here higher the interest rate, the lower would be the present value of the exercise price. So this value gets lower, therefore this value gets higher. Time to expiration, the same thing. Higher the time to expiration, lower the present value, higher the value of the call option. And volatility of the stock price, here it is also relevant. So if the asset is more volatile, then we would have higher discount rate, then the value of the call option would also be higher. So we can, it also makes sense just from the pure logic that the more risky asset, it means that longer the period, higher standard deviation, higher interest rate results to the higher value of the call option, and it also makes sense just from looking at the formula. Now, as here the interest rate affects other sides of the equation, here we talk about direct effect only. Now we are starting to gradually approach the topic of option values. Let's say you are the manager of some company and you might receive the bonus from with the shares of different companies. That will be option on the two types of underlying assets, and they are equal in all characteristics except for the volatility. And in this case, for you, it will be better to choose more volatile stocks as you hedge the risk of such stocks, and you hedge the risk of something that is more risky. This is more valuable as we consider the value of the option, not the value of underlying asset. In order to discuss how the price of the option is determined, we will go step by step, and first we will consider some simplified example. We will also work with the same stock in the same conditions, just advancing our method gradually. We have a Google stock, and we have Google option to buy this stock at the exercise price of 530. The stock price might fall to 424, or it might go up to 662. How to determine probabilities and the price, this is something that we'll explain further. So far, let's just take them for granted. If the price goes up and it is above the exercise price, the value of the option would be this price, 662.5 minus 530. This would be the value of the option, because we can buy something at this amount cheaper. If the market price is lower than the exercise price, then the option value would be 0, because it makes no sense to exercise such option. It's better to purchase the stock on the open market cheaper. So the option value is 0. Now, let's determine the spread of the possible option prices. The spread, it is called the option delta. This is something that we need for option valuation. It is determined as the spread of the possible option price and the spread of possible share prices. The spread of option prices. So option price is either 132.5 or 0. We saw it here. This price or this price. And asset price is this one or this one. And this is how we would determine the option delta. It is 0.555. So this would be 555 to eternity. We round it till the 3 decimal places. So we round it till 3 decimal places, but without the rounding, it would be infinite number of 5s. And as we just discussed, we can replicate options with another assets. And what we can do, we can buy this option delta fraction of the shares at exercise price and borrow the rest of the money from 530 from the bank. This is what we do here. As we borrow, we have some obligation. And as a result, we have some value that is discounted at the given interest rate, which is 61.22. And this is the same amount as we have here. So this is something that we have doubled. So the price can be either go this or that. So eventual result is a average one, and this is what we would get. Slight difference due to the rounding here. Alternatively, we can build another logic here and assume this risk neutral method. This is the similar principle we consider talking about the certainty equivalence. There we also estimated risk neutral cash flows first and then discounted them at the risk-free rate. Here we have the similar principle. We have expected return, which is the same as the interest rate. We have some estimation of the expected increase or decrease of the price, and we can estimate the probability of rising of the price first. Then we know what would be the option value at each case. We estimated that, then we made a discounting because it would happen in subsequent period and have the same value. If we talk about the put option, the principle would be the same, just the different, but the same changes in asset price leads to opposite result for the option value. If the stock price goes down, option price goes up. If stock price goes up, option price of the put option goes down or approaches zero. It is the same, so we estimate the spread of possible option prices. So look here. It would be negative. The option delta for put option is negative for the same principle because it moves in opposite direction, the asset price and option price, and therefore the option delta would be negative. We can also estimate this again. And the principle here, so as it is minus, we can go short on the, in order to replicate the put option, we go short on the underlying assets with a fraction that is equal to the option delta, and lend some amount, which the residual amount, to the bank, having additionally some percent. And therefore, we will have this result. And so we replicated the option with the other two transactions, purchasing or short selling a fraction of the stock plus lending the money. We can build the graph if we have multiple steps in the change in price. We can build the graph, and this approach is called the binomial pricing. We limit all the changes in price to the two alternatives. It either goes up or down. And in order to make it more realistic, we can make more and more steps with a shorter and shorter period, and eventually we can cover all the possible prices. We have some expectations of the price, so it can either rise by 17.09 or fall by 14.6 the price. So we started from 530, and it either goes up or down at the 3 months period, and again it either goes up or down. This interest rate is determined in a way to balance it out. So if it first goes up, then it goes down, we reach the same point, and if it either first falls and goes up, we also reach the same point. And also we will approach further the way we determine it numerically. In order to determine the probability, so we have some potential changes, then we should estimate the probability of these changes. It should remind you the decision trees that we just covered, but here it is more simpler. Everything here is predetermined mathematically based on the assumption on the interest rate and the volatility of the stock. We have the interest rate, potential downside or upside changes, and this is how we estimate the probability of the rising of the stock price. The probability of the stock price to go down is 1 minus this probability. Expected value in 6 months, probability, the value of the option at this point, because this is something we can estimate directly by subtracting the value, by subtracting exercise price from this value. This is how we get 196, this one. Then probability of fall, but in this case the value of the option is 0, and this is how we get this amount. Then we have to discount it in order to get the value that we have here. So we made one step back in order to have value of the option at this point, and then we do it again. We have some values here that we just determined, and then we have probability of going up, of going down. So here we have those two, and then we go one step up to estimate the value of the option now. This is how we did. We multiplied the probabilities at the expected values in 3 months, having some value. Then we discount it because it will happen three months later, having the value of the option. So something that we would put here, 44.19. This would be the option price, call option price, using the binomial pricing model with the 2 steps per 3 months. And the formula, so we gave you initially the potential upside or downside. So this is something that we were here included in the exercise. But we can estimate it using the historical data on the stocks in order to be well grounded. In order to do these potential changes, we use the following formula. E as a base for the natural logarithm. This is 2 and 3 first 3 decimal places of this number. Standard deviation of the stock returns, something that we can estimate on the historical data for the same period that we consider. And the interval as a fraction of the year. So if we have we should have all the periods in accordance. So there we talk about the 3 months period, then it would be 1. If we talk about yearly period and we have a step of 3 months, then it would be 1/4, and so on. So in order to have everything in accordance, we should have this component of the formula. And downside change is 1 divided on the upside change. And this is why, as I showed you, that if the price goes up, then goes down, we reach the same level of the price. And this is due to the way these changes were estimated. If we have standard deviation of 31.56%, and we talk about the 3 months, so 1/4 of the year, we can estimate the potential upside change and downside change, and this is how we got those numbers. So this is 1.1709, so either goes up by 17% or goes down by 14.6%. So this is something that we started from. Let's consider binomial pricing model in a general form in order to repeat it and make sure that we understand how it works. We can estimate the probability of the stock price going up by historical data on the volatility, so on the information on the interest rate, and the rest, like T, depends on the period we consider. This is something that is determined by the exercise we work with. With this data, we can estimate the probability of stock price going up. And so this is the example. We have a price of the asset that we start from, the strike price, standard deviation, fraction of the year, and interest rate. Using those, we estimate all the parameters that we need, and we can build the chart. We start from the market price, and we have expectations on its potential growth or its potential decline. So we multiplied 46 on the expectation of the growth on 1.1215. This would be the price at this point. We also have an expectation of the decline that we estimated, and this would be how we get this number. Then we did it again starting from these points. It can either go up or down. This 36 would be the same for both cases, and we can do it as many times as we need. Then as we reach the final points, so here we have this final prices that we expect. Then we would estimate the value of the options at each of those points, and the value would be difference between the price of the asset and the exercise price, or strike price, and this would be intrinsic value at each of those points. You remember that the strike price is 40, so if the price is above 40, it has some intrinsic value. If it is below, it has no. So at those 2 points, there is some intrinsic value. Here, intrinsic value is 0. Then we move to the left, re-estimating the price. We multiply the probability of the stock price going up by probability of the stock price going down by the option price intrinsic value of it at each point, and we also apply the discounting here. So this is how we would discount, and in this way we go further. So here we made one step to the left, then we make one more step, and eventually we estimate the value of the option at the time of consideration. This will be 1.51. Depending on the number of the periods that we would split our exercise on, we would have different outcomes. So if we have just a single period of the whole of 6 months, then we would have these two types of prices that can happen. If we would split the 6 months on 2 steps, that will be 3 months, then 3 months again, then we'll have three potential prices, and the one would be more probable as there are more cumulative probability will be higher. And as we make more and more steps, that will be shorter and shorter, we would our chart would approach the form of the log normal distribution. Log normal because it is restricted from the lower side because the price of the underlying asset cannot go down by more than 100%. It cannot fall lower than 0. But it can, theoretically, it can go up at any height. And this property is reflected in the log normal distribution, which is the one that we observe here. And this idea, so making infinite number of infinitely small steps in a binomial pricing model, this is something we can do using special tools suggested by Black and Scholes, and that is why this formula is called the Black-Scholes pricing model. Let me introduce it to you. So the principle here is very similar. Just the calculations are slightly different, but common Excel or any other tools enable us to do it very easy. So in order to estimate the value of the call option, would multiply the share price of the delta minus the value of the expected value of the bank loan. So this is the same idea that we just discussed about replication of the option with another more simple asset. So this is what we have here. We have, in order to exercise the call option, we can replicate it by buying some fraction of the share and borrowing some money. And this is what we have here. In order to estimate it, we use the following formula. So this is log normal natural logarithm of the ratio of the market price to the present value of the exercise price. Here we would have a standard deviation, the fraction of the period, and this would be the formula. And then would re-estimate the D, and this ND operator, something that in Excel we would do with the formula norm.s.dist. It's a cumulative normal probability density function. So this is in a plain English, it is a probability that normally distributed variables will be less than this value above this value of standard deviation above the mean. By example, it's quite reasonable to understand. So we have some estimation here, and so we first estimate this D1 and Dn, then we would go to Excel in order to estimate this normal probability density function, and then we multiply it on the expected share price and the exercise price. And these values, they depend on the discount rate, also time to maturity of the option, the same that we discussed earlier. Then we talked about the binomial prices. So this is the same approach, just we need some different mathematical tools in order to estimate this binomial pricing model for the infinite number of periods. This is something that we do here. So if we, for the simplicity, we assume that exercise price equal to the market price at the beginning, then we would estimate D1 and D2. So this is probability if D1 is close to 0 and D1 would be close to 0.5. Here, as it is cumulative normal probability density function, probability that normal distributed variable will be less than D1 standard deviation above the mean. So this number of standard deviation above the mean, the probability that it would happen is equal to this number. Then we would re-estimate D2, apply the same thing for this. D2 is negative, so then the number is negative. We go below 0.5, and D2 is always positive. And then we would re-estimate, then we would put numbers into formula and estimate the option value of the call option. So this is, you see that the value is close to the one we determined. Then we used binomial pricing model, but it is slightly different because here we work with infinite number of periods. Infinite number of very small periods which are put together in 6 months. If we change the, depending on the different stock price, we would have different value of the option, which is presented here on the green line, and the boundaries are predetermined. So this is something that we discussed with you here. This is presented on the chart for our example. As we know that the options depend on the volatility, this idea leads to the using of these volatility indexes using the option valuation in order to estimate the risk of the market. And you can see this volatility index of S&P, volatility index of NASDAQ, estimated as an option price on such types of assets. So when you interested in the current estimation of the risk on the market, you can look for the options on, for example, on those indexes, and the value of the option is a good sign of the current state of the risk. And here, this is well aligned with the crisis events. So far, we discussed how to estimate only call options. We did it because estimating the put option is a very technical thing, knowing the call option. And we derived this from our put-call parity formula. So here it is. It is the same formula, just rewritten in a way to estimate the put price. Additionally, we can add some cash flows associated with having the option, which would be the carrying costs associated with the option, and the dividends that we might receive having the having those underlying assets, if we talk about the stock. And knowing that, we can estimate the put option. So the principle here, we would first estimate the call option, and if we are interested in put option, then we would derive the value of the put option from the call option with this principle of the put-call parity. This is it for today. This topic, today we have only introduction into the topic, and this topic particularly needs you to make some exercises in order to estimate the option value using different tools. You will have opportunity to do it in your seminars. And once you practice it once or two times, estimate it yourself, it makes a very good sense. So please do not lose this opportunity. There are just few ideas. So this idea about the put call parity, this idea on the factors that would affect the option price, the idea that more risky assets have options which are more valuable, and these ideas should settle in your head, and then you will successfully work with these types of instruments. Do you have any questions, comments, suggestions, or anything you want to discuss? Good. Please do not forget about the homework, because the deadline is approaching. Do not leave everything on the last day, and we see each other next week. Goodbye.
Thank you. Bye.
Thank you. Goodbye.
Bye.